Hey there, my name is Steve Coughran. I'm the founder of Boosting Your Financial IQ. Do you want to know what's whack? Whack is the weighted average cost of capital. And in this video, I'm going to walk you through something that could be very complex on paper or academically, and I'm going to make it very simple because I'm going to share with you a model that I built that you can download and you can very quickly compute your company's cost of capital, which is really critical when you're building discounted cash flow models or you're trying to determine valuation. So join me for this episode, and I'm going to help you to boost your financial IQ in this very critical area. All right, let's jump into computing the weighted average cost of capital, also known as wiggity wiggity whack. Okay, this is going to be an important lesson to learn because this is so integral to building DCF models in finance. So understanding the weighted average cost of capital is critical. I'm going to make it very simple for you. And I've even created a calculator that you could download to follow along and to shortcut this entire process. So let's jump in. Now, before we get started, remember that this content is for educational purposes only. If you want to learn more about our privacy policy and terms of use, you could go to byfiq.com. Okay, before I jump into the model, I have to explain what a capital structure is. Now, if you know the balance sheet is balanced by assets on one side. Okay, so you have assets, and those assets equal debt plus equity. So a company is able to maintain its assets through some type of combination of debt and equity. Some companies have just a little bit of debt. So they may have 90% equity, 10% debt. Some companies may have 60% debt and 40% equity. There's some combination, though, for every single company, and this is known as their capital structure. Now, there's a cost to this capital structure. Okay, in order to get debt, to borrow money, you're paying interest expense. All right, so there's a cost to that. Now, with equity, you have investors. The investor can be yourself. You could be bootstrapping your business and just putting cash into your company. If you put cash into your business, you're going to want to expect a return greater than what you can earn just in the market. Otherwise, don't go into business. Just take your cash and invest in stocks in the market. So obviously, you're going to want some type of return. So even though you're not paying interest expense, and even though there's no guarantee when it comes to equity, like paying a check to investors, you have to provide some type of return. Otherwise, they're going to lose interest. They're not going to give you more capital, and you're not going to have the cash needed to grow and fund your business. So you have investors, you give them ownership rights to the business in exchange for cash, and then that cash helps you to develop and grow the business. So as a business owner, you can choose your capital structure to a point. Sometimes you don't choose it. It chooses you. You have a lot more debt than you want. You want more equity, but your business isn't at that place. But you can decide to take on more debt or less debt. You could take on more equity or less equity. So every single business is different. So when we're trying to determine the valuation of a business, and check out the other videos that I put out there about unlevered and levered discounted cash flow models and how to build discounted cash flow models. And I have a course called Investing in Stocks and Financial Assets. All of these concepts center around valuation. And when you're doing a valuation, you have to understand what the cost of capital is. So let's jump into the tool that I created, and let me walk you through how exactly you compute weighted average cost of capital. Okay, here we are. We are in the weighted average cost of capital calculator that I created. Before we get into the numbers, I want to just point out something. So if you ever have a model, and I intentionally did this, but if you ever have a model that has these pound divs or pound refs, all right, that's not a good thing. Even though you may say, well, it's because we got to put numbers in here and then it'll go away. It just doesn't look real great. So I can show you a real quick tip. This is kind of like an extra bonus here. If you have something that's being divided by 0, it's going to give you a pound div. So if you just come in here into the formula bar, you go if error, okay? And you're essentially going to just tell it, if there's an error, put a 0. And I'm going to just copy that down. Okay. And that fixes the pound div. Beautiful, right? So the if error formula is great. So even here, you can say instead of a 0, you can say if there's an error, you can say you are fired. You can do that. You can mess around and create some entertainment for whoever is lucky enough to work in your models. But we're going to put a 0 in here for now. I wanted to show you that because anytime I see a pound div or a pounder F, I'm like, oh my gosh, this model, do I even trust it? All right, so here's the model that I've built for you. Essentially, this does all the work. What we're going to do is we're going to look at cost of capital from the two sections that I talked about, debt and equity. So with debt, if you want to compute your debt, what I would do is come in here and enter in the debt source. So let's just say you have a Wells Fargo line of credit, and maybe you have a JP Morgan Chase term loan, and maybe you have an auto loan. Okay. And in here, these numbers are in thousands. You can modify the model to be whatever you want, but I just put this in thousands. But let's just say that we have $855,000 in a line of credit. In a term loan, we have 1,355.5 million. And then the auto loan, let's just say it's 55,000. All right. Now this column right here will calculate the weight of these loans in relation to the total amount of debt. Okay. So in other words, the Wells Fargo line of credit is 38% of all the debt. The term loan is 60% and the auto loan is 2%. Now for the rate, you're going to use the rate that you're either paying, or if you're trying to create some future forecast, you're trying to use a weighted average cost of capital for some type of future forecasted model, you're going to want to use the rate that you anticipate paying. So if you expect interest rates to go up, then you're going to want to use that anticipated rate. Alternatively, if you're just trying to compute your weighted average cost of capital as of today, just use the rate that you're paying right now. If it's a line of credit and it's going up and down because it's tied to LIBOR, then you're going to just take an average over a certain period, right? But let's just say here for simplicity's sake, the rate that we're paying is 6.75%. On the term loan, we are paying 5.9. And then on the auto loan, we're paying 5.25. All right, so we put the rate in here, the interest rate on each of these debt instruments. And you'll notice here this column after tax. So the nice thing about interest is that interest expense, typically, if you have the income to offset it, it's tax deductible. So therefore, it reduces your true cost of debt. So right here, I just have this effective tax rate cell up here, 40%. And so this is just taking the 6.8% times 1 minus the tax rate. And that's where I come up with 4.1% as an after-tax cost of debt. So make sure you do that, because remember, interest expense is tax deductible and you have to account for that in your cost of debt. Otherwise, you're going to overstate what your true cost of debt actually is. Another thing with my models, I should have mentioned this at the beginning. All my models that I build, the input cells are blue. Okay, so right here in the model, you'll see all these blue cells are input cells. The cells with black font, these are all formula cells, so don't touch those. So that's how I build my models, and it keeps it really clean. And you can incorporate something like that when you're building models. Blue cells, blue font cells are input cells. Black font cells are formula cells. Green cells, green font cells reference another worksheet. And a red font cell indicates some type of assumption that's critical to pay attention to. But don't get like rainbow bright with your spreadsheets. Don't be creating a bunch of colors and highlight things green, yellow, purple. I mean, it's just so unprofessional. Just keep it really clean and simple. And that coloring methodology accomplishes that. And you know exactly where to enter numbers and you're not typing over formulas. Here we have the weighted amount of debt compared to all the debt. We have the rate, and then we consider the impact of tax. So we have the after-tax rate. We multiply the after-tax rate by the weight over here in column D, and we come up with the weighted rate. If we add all these up here, that will give us our total weighted average cost of debt. So when I'm highlighting over it, it's 3.72%. Okay. So we come down here, 3.72% is our cost of debt. Now, I haven't put anything in here for equity, so let's add that to it. Now, let's just say with my equity, I have $3.5 million in total equity. And for the rate, okay, this is where it gets like so academic. And there's like the CAPM method where you're taking like the risk-free rate times the market risk premium, all this stuff, right? And beta, and you have all these academic variables. You could do that. Okay. There's nothing wrong with that. You could do that. That's great. But for the majority of people, there's a much simpler way. And here's the simpler way. For the rate of cost of equity, you can use the historical returns on the S&P 500. Okay. So that's one way to figure out the cost of equity. That's what the market has been returning. So you could come in here and do 8%. If you want, look up the CAPM method. That's one way to figure out the cost of equity. But I provided in here this little appendix. If you download this tool, this is from Stern, NYU, the business school there. And they have the cost of equity by industry already computed out. And they have other things such as like the cost of debt. So you can just check yourself. Now, remember to get the updated version because interest rates have changed quite a bit. And you're going to want to make sure you're using numbers that match the current economic conditions. But in here, yeah, just this is for illustration purposes. I provide the link there to get the update. But you can compare the cost of equity here. And you may say, okay, well, we are in the air transport business. Well, there's your cost of equity, 9.38%. You can use whatever. But for this sake, let me just add these up here. And you have the total market return on equity is 7.79%. Without financial companies, it's 8.2. So in my model, I'm just going to use 8% for this example. But now you know how to check yourself, right? You can be sophisticated, you can do whatever, but just don't get too crazy here or you'll waste time and you'll get too academic on yourself and you'll get completely lost. All right, so 8% is our cost of equity. Now you may say, well, what does that mean? Remember what I said, dividends aren't always guaranteed for investors. Okay, there's no guarantee really when it comes to equity. Like if a company goes out of business, if there's no money left after paying the debt holders, equity providers walk with nothing. However, when they invest their money in your company, there's this implicit return on equity that they're expecting. This is the expected return. Otherwise, they're not going to give you equity. So you have to account for that. And that's what we're doing here. And we're saying, look, if they had cash, they could put it in Apple or Microsoft or Google or Amazon, some other type of stock in the market and earn a return. So why would they put it in your company? So that's the inherent cost here or the opportunity cost. If you're bootstrapping the business and your cash is tied up in the business, this is how you account for it here. So I'm just going to put 8%. So we have our weighted rates on debt. We have our weighted rate on equity. You add those together, it's 6.3%. Here, I just have this little risk premium buffer. So you may say, I don't feel super confident about some of these numbers. Maybe you have variable debt and you don't know how to account for that, or there's other risks in your calculation. You could come in here and add maybe 1% or 2% or whatever you want to add to it, 5%. You have your computed weighted average cost of capital, 7.3%. Remember, we were just talking about what if we were in the air transport business, 9.38%. I'll just put that in there for fun. And there you go. The industry average, weighted average cost of capital, wiggity whack, is 9.38%. We computed 7.3. All right. So that just helps you to check yourself. Also, just in your models, just real quick, just make sure that everything's formatted correctly, like 1 decimal point on everything. Sometimes when I change stuff, it modifies it as well. Here, I'm just going to put everything with 1 decimal point so it's all consistent. Consistency is key in your models. Like keeping a very clean model is really, really important. But there you go. That's how you use the weighted average cost of capital tool. You can get this by joining the Boosting Your Financial IQ community. Go there. You could download this, use this to your liking. You can modify it, manipulate it, whatever you want to do. But here you go. This is a valuable tool that will save you a lot of time when you're computing your company's weighted average cost of capital. Hey there, I hope after this video, you feel so much more confident when it comes to computing wiggity whack or weighted average cost of capital with a formal definition. But no, I hope that this tool will help you to compute this very quickly and accurately within your organization. If you got value out of this video, it would mean the world to me if you like it, if you share it, if you provide comments. So make sure you smash that like button for me. And then also, if you're not already a member of the Boosting Your Financial IQ community, you could go to byfiq.com and you can sign up today to download this tool, the weighted average cost of capital tool, and gain access to other valuable resources that will help you along your journey to achieving a better financial life. If you haven't already, subscribe to this channel so every time I drop a video, you will be notified. And in the meantime, take care of yourself.